Something very unusual is building in the global financial system right now, and most people are not seeing it clearly yet. On the surface, everything looks stable. Stock markets are continuing to rise, bond markets are holding up, and financial headlines are trying to show confidence and stability. But when we look deeper into the structure of the system, a completely different picture starts to appear. Behind the scenes, central banks and financial authorities are actively working to maintain liquidity in the financial system. Their main objective is very simple: prevent any kind of financial instability. This means ensuring that banks remain stable, credit markets continue functioning, and financial panic is avoided at all costs. But here is where things start to become very important for gold and silver investors. Whenever liquidity is continuously added into the financial system, it does not affect all assets equally. Some assets react slowly, while others respond much faster and more aggressively. This is a well-known pattern in financial history. Stock markets and bond markets often benefit first because they are directly connected to institutional liquidity flows. Government bonds, treasury markets, and large-cap equities tend to remain supported as long as liquidity conditions are stable. But there is another category of assets that behaves differently: hard assets. Gold and silver belong to this category. Unlike stocks and bonds, gold and silver are not dependent on earnings, dividends, or financial system promises. They are physical, finite assets that respond strongly to changes in currency value and long-term liquidity expansion. This is one of the key reasons why many analysts pay close attention to gold and silver during periods of monetary expansion. When liquidity increases over time, the purchasing power of currency slowly decreases. This does not always happen suddenly, but it happens gradually and consistently over long periods. And during these periods, hard assets often begin to outperform in real value terms. Welcome to Gold Silver Scope, where we break down global gold and silver market behavior in simple, clear, and practical language, so you can understand what is really happening behind the financial system. In this analysis, we are going to explore a very important question. If central banks continue to support liquidity and financial stability, what does that mean for the long-term direction of gold and silver? To answer that, we first need to understand how the financial system is currently being structured and why this structure is creating long-term effects that most people do not notice in the short term. Right now, financial authorities are focused on maintaining stability in three major areas. First is the stock market, which represents corporate value and investor confidence. Second is the bond market, which represents government borrowing and interest rate stability. Third is the broader financial system, which includes credit markets and banking stability. As long as these three areas remain stable, policymakers consider the system to be under control. However, maintaining this stability requires continuous liquidity support, and this is where the long-term impact begins to form. Because liquidity does not stay neutral, it always flows somewhere. It enters financial markets first, inflating asset prices, and then gradually spreads through the economy. But the effect is not equal for everyone. Some groups benefit earlier, while others experience the effects later. This uneven distribution of liquidity impact creates long-term financial divergence, meaning the gap between asset owners and non-asset owners slowly increases over time. And this is exactly the type of environment where gold and silver start to become more relevant. Not because of short-term speculation, but because of long-term monetary pressure. When currency slowly loses purchasing power, real assets tend to gain importance as a store of value. As we go deeper into the current financial structure, one thing becomes very clear. The system is heavily dependent on liquidity. Right now, global financial authorities are focused on keeping markets stable at all costs. This includes stock markets, government bond markets, and the overall credit system. The reason is simple. If any of these areas break down, it can trigger wider financial instability. To prevent this, liquidity is continuously managed and adjusted. This creates an environment where financial markets often remain elevated, even during periods of economic uncertainty. Stock indices can rise, bond yields can be controlled, and investor confidence can be maintained. On the surface, this looks like a strong and healthy system. But when we look deeper, we see a different reality forming underneath. Because liquidity does not just stabilize the system, it also changes how value is distributed across assets. When new liquidity enters the financial system, it usually flows into large, established financial instruments first. This includes government bonds, treasury securities, and large-cap equities. These assets tend to react quickly because they are directly connected to institutional capital flows. However, this process also creates a side effect: asset inflation. As liquidity supports financial markets, asset prices rise faster than wages in most cases. This means that while financial charts may look strong, the real purchasing power for many people does not grow at the same pace. This creates a growing gap between financial asset holders and non-asset holders. Now, this is where gold and silver start to become very important in the long-term picture. Unlike financial assets, gold and silver do not depend on corporate earnings or government debt structures. Instead, they respond more directly to changes in currency strength and liquidity expansion. When liquidity increases over long periods, the value of currency slowly declines in real terms. This does not always appear in daily life immediately, but it becomes visible over time through rising costs of goods and services. In such an environment, hard assets naturally gain attention because they are not tied to the same financial system risks. Another important point is how financial narratives often focus on headline performance. For example, rising stock markets are often used as a signal of economic strength, but this does not always reflect the full picture of economic conditions for all groups in society. Because while financial markets may show growth, the distribution of that growth is not equal. Some groups benefit significantly due to early access to liquidity and financial assets, while others experience more pressure from rising costs and slower income growth. This creates a structural imbalance over time. Historically, similar patterns have been observed in different economies during periods of currency expansion. Financial markets appear strong, but real purchasing power becomes more uneven across society. This is why long-term investors often look beyond short-term market performance and focus more on monetary trends. Gold and silver become important in this context because they act as long-term stores of value that are not dependent on financial system expansion. They represent a form of protection against gradual currency dilution. At the same time, financial policy continues to focus on stability. This means that liquidity support does not disappear quickly. It tends to remain part of the system for long periods. And every time liquidity is extended, it reinforces the same structural effect again: stronger financial markets on one side and gradual currency pressure on the other side. This dual effect is one of the most important dynamics to understand when analyzing gold and silver, because it explains why these assets often move differently compared to stocks and bonds during long financial cycles. While stocks and bonds reflect financial system performance, gold and silver reflect monetary system pressure. This difference is what creates long-term divergence in performance. And this is exactly why gold and silver remain central in macro-level financial analysis. As we move deeper into the structure of the global financial system, one of the most important factors we need to understand is how wealth is distributed and how that distribution is changing over time. Financial data over long periods shows a clear and consistent pattern. Wealth is not evenly spread across society. Instead, a significant portion of total wealth is concentrated in a relatively small group of people, while the majority of the population holds a much smaller share. This is not a short-term trend. It is a long-term structural feature of modern financial systems. Now, when liquidity is continuously added into the system to maintain financial stability, it does not flow evenly to everyone at the same time. This creates a timing difference in who benefits first. And this timing difference is extremely important because the people who receive access to liquidity earlier are able to position themselves into financial assets before prices fully adjust. These assets include stocks, bonds, real estate, and other financial instruments. As a result, they benefit more from asset price expansion. On the other hand, those who do not have early access to liquidity tend to experience the effects later, often in the form of higher living costs and slower relative income growth. This creates what we can call a widening financial gap. Over time, this gap becomes more visible as asset prices rise faster than wages. This means that owning assets becomes increasingly important for maintaining purchasing power. Now, this is where gold and silver become very relevant in long-term financial thinking. Because unlike financial assets that depend on liquidity timing, gold and silver are not tied to the same system structure. They exist outside of corporate earnings cycles and government debt mechanisms. They are influenced more by long-term monetary conditions. One of the key concepts that helps explain this is known as the Cantillon effect. This concept explains that when new money enters an economy, it does not reach everyone equally at the same time. Instead, those closest to the source of new liquidity, such as financial institutions and large asset holders, benefit first. They are able to purchase assets, goods, and investments before prices fully adjust to the new money supply. By the time liquidity spreads through the broader economy, prices have already adjusted upward, and the purchasing power of currency has already declined. This creates a structural advantage for early receivers of liquidity and a disadvantage for later receivers. Over long periods, this effect contributes to widening wealth inequality and stronger asset price inflation. Now, when we connect this to gold and silver, the picture becomes clearer. Gold and silver are often seen as protection against this type of system behavior because they do not rely on timing advantages within financial liquidity cycles. Instead, they reflect long-term changes in currency value and monetary expansion. This is why in many historical periods where liquidity expansion has been strong, hard assets have played an important role in preserving value. Another important factor is that financial systems today are far more complex than in the past. Modern markets include not only stocks and bonds, but also derivatives, credit instruments, and private financial structures that are not always visible in public data. These layers add complexity and interconnected risk within the system. Because of this complexity, financial authorities often prioritize stability above all else. And maintaining stability usually requires continued liquidity support. This brings us back to the same cycle again. Liquidity support leads to asset inflation increases wealth concentration, and wealth concentration increases reliance on financial system stability. This cycle reinforces itself over time, and within this cycle, hard assets like gold and silver continue to gain attention because they sit outside of this structure. They do not depend on financial engineering, credit expansion, or institutional leverage. Instead, they represent a form of independent value storage that is tied more closely to real-world monetary conditions. This is why many long-term analysts focus on them during periods of structural financial change, because they are not just commodities, they are indicators of monetary stress and currency behavior over time. As we move further into the current global financial environment, another powerful layer begins to appear: the interaction between monetary policy and technological change. On one side, central financial authorities are focused on maintaining stability in the system. On the other side, rapid technological development is changing how economies function at a structural level. This combination is extremely important for understanding long-term trends in gold and silver. First, let's talk about monetary policy. The main priority of financial authorities is stability. This means ensuring that financial markets continue to function smoothly, credit systems remain active, and major disruptions are avoided. To achieve this, liquidity support often becomes a key tool. Even during periods where inflation or economic uncertainty exists, financial systems are often supported in order to prevent deeper instability. This creates a situation where financial markets can remain elevated, even when underlying economic conditions are uneven. Stock markets, bond markets, and large financial institutions often remain supported because they are central to system stability. However, this does not mean the entire economy experiences the same effect. Because while financial markets are supported, the real economy experiences different pressures, especially in terms of cost of living and income growth. Now, when we add technology into this equation, the picture becomes even more complex. Artificial intelligence and automation are starting to change productivity across multiple industries. Tasks that previously required large workforces are now being handled more efficiently through algorithms and machine systems. This increases productivity and reduces costs in many areas. However, it also creates structural changes in employment. Some jobs become less relevant, while others require new skills or shift entirely into different sectors. In the short term, this can create uncertainty in labor markets. In the long term, it can lead to a more efficient but also more concentrated economic structure. Now here is where monetary policy reacts. When economies go through structural transitions, policymakers often respond by ensuring stability in demand and financial systems. This can lead to continued liquidity support to prevent disruptions during transition periods. So instead of reducing liquidity, the system often adapts by maintaining it or adjusting it gradually. And this brings us back to a key long-term pattern. Whenever liquidity remains elevated for long periods, it influences currency value over time, not always in a sudden way, but in a gradual and structural way. This is where gold and silver become very important again. Because they are not directly tied to productivity systems or technological cycles. Instead, they are tied to monetary conditions and long-term confidence in currency value. Another important factor is financial complexity. Modern financial systems include not only traditional markets, but also derivatives, credit instruments, and private financial structures. These areas are often less transparent and harder to fully measure in real time. This complexity increases the importance of stability-focused policies. And stability-focused policies often rely on liquidity tools. So the cycle continues. At the same time, there is also a growing narrative in global markets suggesting that technology will reduce costs over time and lead to a more efficient economy. While this may be partially true in terms of productivity, it does not automatically eliminate financial cycles or liquidity dynamics. Because even in highly productive systems, financial stability still needs to be maintained. And whenever stability is prioritized, liquidity remains a key tool. This is why long-term monetary expansion trends can continue even in technologically advanced economies. Now, when we combine all of this, liquidity support, technological change, financial complexity, and wealth distribution, we begin to see a clearer long-term picture. Financial markets can remain strong, but currency value can still experience gradual pressure over time. And this is the environment where hard assets become more relevant. Gold and silver do not depend on productivity cycles or financial engineering. They respond more directly to long-term monetary conditions and systemic balance. This is why they continue to appear in discussions about long-term protection and diversification strategies, because they sit outside the core structure of financial leverage and credit expansion. They are not dependent on system growth, they are dependent on system value preservation. As we reach the final part of this breakdown, it is important to bring everything together into a clear and simple long-term picture. What we have seen so far is not a short-term market story. It is a structural financial environment that is slowly shaping how assets behave, how wealth is distributed, and how currencies function over time. On one side, financial markets such as stocks and bonds can continue to remain supported due to ongoing stability-focused policies. Central financial authorities aim to prevent instability, and this often leads to continued liquidity support within the system. This support helps maintain confidence in financial markets and prevents major disruptions in credit and banking systems. However, on the other side of the system, something very important is happening at a deeper level. The long-term value of currency is gradually influenced by continuous liquidity expansion and structural financial adjustments. This does not always appear immediately in everyday life, but over time it affects purchasing power and asset pricing relationships. This is why financial markets and real-world purchasing power do not always move in the same direction. Now, when we look at gold and silver, we begin to see their role more clearly. Gold and silver are not tied to corporate earnings, financial engineering, or debt structures. Instead, they are tied to monetary conditions and long-term confidence in currency value. This makes them unique compared to most financial assets. In environments where liquidity remains elevated for long periods, financial assets may continue to perform, but hard assets often gain attention as a form of long-term balance and protection. This does not mean financial systems collapse. It means the balance between different types of assets slowly shifts over time. Another important point is portfolio behavior. In different financial cycles, many long-term investors tend to adjust their exposure rather than concentrate everything in one category. Instead of relying only on financial assets like stocks and bonds, they gradually include real assets such as gold, silver, and commodities to create balance. The purpose of this approach is not speculation, it is stability. Because financial cycles are not linear. They move in phases of expansion, adjustment, and rebalancing. And during these phases, different asset classes behave differently. Gold and silver often gain attention during periods where currency pressure, liquidity expansion, or financial uncertainty becomes more visible. At the same time, it is also important to understand risk management. One of the most important principles in any financial environment is avoiding excessive leverage or debt exposure, because when liquidity conditions change, financial pressure can move quickly across different parts of the system. Maintaining flexibility becomes an important part of long-term financial stability. Now, when we step back and look at the bigger picture, a few key themes stand out. Financial markets are supported by liquidity to maintain stability. Wealth distribution is uneven and changes slowly over time. Technology is reshaping productivity and employment structures. Monetary systems remain central to long-term asset behavior. Hard assets continue to play a role in preserving value over cycles. When all of these factors combine, they create a long-term environment where different asset classes behave differently, depending on monetary conditions. Gold and silver continue to stand out in this structure because they are not dependent on financial system expansion. Instead, they reflect long-term currency behavior and systemic balance. This is why they remain central in macro-level financial discussions and long-term strategy thinking. Final call to action. If you want more deep, simple, and professional breakdowns of gold and silver markets, make sure you stay connected with Gold Silver Scope. We focus on breaking down complex financial systems into clear insights so you can understand where the real long-term opportunities and risks are forming.